I'm Matt Smith. If you're a fan of the channel, you may have noticed that there's not been very much new content lately. If you didn't see my announcement, the reason for that is that I recently joined Emmett Peppers at his new hedge fund, Good Soil Investment Management. Emmett, for those of you who may not have heard of him, although I'm sure that's very few of you at this point, Emmett has made outstanding personal returns and generated wealth in the tens of millions of dollars. He's been very open with his story on a series of interviews with the Dave Lee on Investing channel. I highly suggest you check out those videos if you haven't seen them already. But what I hadn't heard in a lot of the conversations with Dave up until I reached out to Emmett directly was why he would even start a hedge fund in the first place and kind of what was his motivation and what was his personal reason for wanting to start something so ambitious, given the fact that he didn't necessarily need it for the money. The answers that I heard from Emmett really resonated with me and really made me pleased to join the fund. So I hope this conversation will be enlightening to all of you to kind of hear this aspect of the stuff that Emmett's been working on. And without further ado, here's my conversation with Emmett Peppers. Well, thanks, Emmett. Thanks for taking the time to join us here out on Spark Spread today. The first video we've done in quite a long time.
Yeah, looking forward to chatting about this our agenda today a little more formally and making it a little more public, and looking forward to hear what kind of discussions we come up with here.
Yeah, so I first reached out to you towards the beginning of this year. Frankly, I didn't know very much at all about Good Soil investment and kind of what you were doing there. So for those who may be in a similar situation, just not knowing very much about what you've done with Good Soil, but maybe know some of your investments from the Dave Lee interviews and some of the other media that you've done out there, can you maybe just kind of give an overview of what Good Soil is and why you started it?
Yeah, so up until late last year, I worked for a firm called Interactive Brokers in prime brokerage sales. So for the last 10 years or so, I've been a prime brokerage salesperson to startup hedge funds. Was a big category of customers. So I'd seen firsthand hundreds of hedge fund managers who I've helped, whether they're leaving a billion-dollar hedge fund to become their own portfolio manager, their own fund, or whether they just have always had a dream to start a hedge fund and they're coming from some other business industry, or all kinds of backstories to people starting hedge funds. And it was kind of fun being the salesperson trying to help enable them to start their own like small business, so to speak. And so in the back of my mind, that was always like a dream of mine as like a next step. If I could invest well enough personally and have enough savings at some point, then maybe I could start my own hedge fund too. And the chances of success are very slim though. Like, I saw many of these fund managers, come and go quickly. It's within 2 or 3 years, most of them fail, like a restaurant, starting a new restaurant, but it was still something I wanted to try.
So how long had you been thinking about that? Is that something that as soon as you had that job, the kind of seed was planted, or is it maybe just a thought that kind of grew over time as you had more exposure to some of these startup hedge fund managers?
Yeah, it kind of grew over time, I would say. Being on most of my life, I worked on what's called the sell side of financial industry, like the brokerage side of the business, servicing hedge funds and asset managers and registered investment advisors and traders. And I always wanted to kind of go to the buy side and see if I can have a business, trading and investing, my money and other people's money to grow over time. And it just seemed the risk reward was a much higher ceiling if you're on the buy side and do really well. So I was driven obviously by just making more money, like most people, I would say, in our society. And that just seemed like the next relevant step for me once I reached, a level where I felt comfortable enough to retire from that job and kind of do this. So that was sort of my original plan. Last year, the markets were very volatile, and people who've seen, the Dave Lee interviews understand probably how I maximized, I feel like, the reward opportunity on both the downward move of the COVID crash and the upward move with a bunch of leap and call options on growth stocks, and Tesla especially, came into its own. And so I had an incredible return, and my net worth sort of jumped exponentially. It didn't go to that next level that I needed to start the hedge fund. It went beyond that, and it was like,
I'm sure it
wow,
wasn't really in the plan, right? Like you
it
make some
wasn't in
good
the plan.
investments, but you don't think
Yeah.
you'll do that well, right?
Yeah. I thought my net worth might go from 1 or 2 million to like 5 million or a little more, 5 to 10 million to start my own hedge fund, but this time it went from, 1 to 2 to like almost 100, before taxes, it went to like 100,
Yeah.
million. And so it jumped, to like multiple levels to where I didn't really find interest in starting a hedge fund anymore to just make money. I felt like, oh, I have enough money. I don't need to, like, I kind of lost that interest very quickly. And also the COVID crash, and
Hmm.
you just didn't know how close the world was to ending or not, through all of this. I was managing my financial portfolio well, but like, you're not allowed to go anywhere. Schools are closed. Everyone's locked down in their houses. And the fear out there, it was just crazy. And you just weren't sure, like, what's happening here? How serious is this? Are we going to kill off like a
Hmm.
significant percentage of our population? Or so like money became less meaningless because of that too, to me, or less meaningful, I guess. It changed my mindset on things a lot. So it was two things, the income, the net, the net worth jumped up much higher than I ever anticipated. And, you just didn't know what was happening. So I had a period of time where I was kind of like not sure what to do. And I knew I couldn't work at my job anymore. I could, but I was like, at some point I need to do something else, other than work
There
at my
wasn't the
job.
fulfillment with your, normal 9 to 5 job anymore. And you were kind of looking for, that next thing now that you don't need the job for the money to take care of your family and kind of get your purpose from that, vessel of your life, which had been so important. You were trying to divert into something that would be really meaningful to do with your time.
Absolutely, absolutely. And so it was like a new a soul searching. Like I had to really think about it and pray on it. And I don't often talk about religion or anything like that, but I'm Christian, and I've been uh, doing this virtual men's Bible study with my church, trying to stay connected with them through all this and stuff. There's just like a few of us, and preparing for that, I was reading one night the parable of the sower. It's referenced in a few of the Gospels, the New Testament Gospels. Basically, it says the seed that falls on the good soil returns 50 or 100x return. And so at that, something just clicked in me, and I like slept on it, and it wasn't like it clicked in me, but I didn't make my decision immediately. Like I wanted to think
Hmm.
it through first. Sometimes I make decisions immediately, and I'm not sure that's the best thing. You want to kind of like, but the idea clicked, and then I wanted to think about that idea and let it stew for a while and pray on it more and more. And over the next month or two, it just came like, that's my investment strategy or investment return. Sometimes some years in 2013, 2014, I had a similar like 50x or 100x return. And then I kind of like went sideways mostly until, because I was big on Tesla options, and Tesla wasn't coming up a lot, but I was able to manage those in a way where it didn't lose money, but I was kind
Hmm.
of just sideways. In 2019 or 2020, it went up 100x again, my return. And so I was thinking, if I do have some unique skill God gave me that other people don't have, maybe it's just luck. I could be just lucky. I don't know. But if I do have some unique skill that I was, given, by God or whatever, then I should try to do something good with it instead of just increasing my own net worth exponentially. That just seems kind of selfish if that's the case. I could do good with that money, of course, but maybe I can do even more good than just like, you know, donating my own money, for example, over time. Um, so I thought, okay, maybe I should start a hedge fund and kind of market my return and strategy and do my original plan, since I already have the know-how from my previous job and I was planning on that, but I could do something a little different that's like good. And, a concern of mine has always been kind of capitalism under fire from, socialism in the younger generation, whether it's Bernie Sanders or who knows. It just seems like there's a
Yeah,
bigger and
these
bigger.
comments of, oh, like all the billionaires made like $30 billion over the COVID crash, while workers lost their jobs. And, that whole
Yeah.
mantra is seen in like proposals of a wealth tax, and just some of the general sentiment that I think we've seen out in the country. This is something that has concerned you as a capitalist, I take it.
Yes, absolutely. Yeah. I mean, and a lot of it has to do with studying it carefully and closely from my old boss, from my old job, Thomas Petterfy. He grew up in socialist Hungary, and moved over here penniless. So he's very experienced in social, and he's been very concerned about socialism taking over in one of these next election cycles too. And at first I kind of thought he was, 10 years ago, I think, was when I originally heard of his concern about it. But in this latest election cycles, he's expressed those concerns time and again. And it's sort of grown on me. And I see the trend, with the younger people kind of who haven't really experienced capitalism yet, but they learn in college professor classes in theory, Marxism or socialism is perfect. But in reality,
Yeah.
they're not understanding that it doesn't work, like it's been tried many times and it's just a disaster. So anyway, I'm just concerned that, too much percentage of our population are eligible voters. Once it crosses that threshold where people can vote on more of a socialist government, then everyone's dependent on the government from that point forward, and they keep voting that type of government forward, and it's just sort of the end of our society, the beginning of the end. It might take 5 or 20 years, but at some point we would eventually kind of lose our footing. Anyway, that's a tangent, but that's always been a concern of mine, and I thought somehow wrapped in together with the good soil parable and the hedge fund startup. And hedge funds like the most capitalistic thing you can think of, that's often complained about. Hedge fund managers making billions of dollars over here, and these people are on food stamps. What's wrong with our society? People say, and so maybe something I could do is try to help change that perspective. That's kind of what I thought about.
Yeah, which, if I could just jump in here, I mean, that was frankly my perspective from, spending a little bit of time in the financial services industry. So, I worked in investment banking, doing sell-side M&A advisory for a couple of years, and had a lot of experience, working directly with, large private equity investors and that sort of thing. And, my own view on this side of the market after kind of working there is just that it kind of represented the worst of of capitalism, where you had agents who had authority over hundreds of millions of dollars and how it's deployed, and essentially would kind of load up companies with debt, to the detriment of workers. I mean, really kind of increase the risk that these businesses would go out of business. And I saw very little social value in a lot of the kind of financial engineering that was going on at least most of the private equity firms that I ended up working with. And hedge funds, I've known a couple people in the hedge fund industry as well. And, the kind of folks that just had, houses in the Hamptons, and, would kind of always be looking for the next thing in life as if that would really make them happy. And, I kind of knew from my own experience that, the first big bonus is not exactly, it doesn't change your life. It doesn't give you the happiness that you might think it will. So,
Yes.
I kind of came into this conversation with you when we spoke earlier with that kind of perspective on hedge funds and what they are. But I didn't really realize that, as you were just kind of, I think, getting to before I interrupted here,
Sure.
you kind of set it up differently than any other hedge fund that I've ever heard of. So can you talk a bit about the structure and how it's different and what we're doing when we say, capitalism for good?
Yeah. So I've seen, the trend with ESG investing, and that's sort of a little bit of a bright spot in the investment management world. Environmental, sustainable governance, I think it stands for ESG. And there's like these scores. Investment managers investors are clamoring for their investment managers to invest in ESG companies. But I feel like that's become very commercialized over time. But it was a good intention, and it still serves some good. But I thought, that sparked my mind and thought maybe there could be a new trend started. And so I set up the structure of my fund to have a charitable giving aspect where, and you've seen Salesforce do something like this where they donate 1% of their revenues, or, but that's not a hedge fund, that's just a business. So I thought maybe I can set up my hedge fund with a standard, 2 and 20 structure is what they call it, 2% management fee per year and 20% performance. But then I can have half of those fees, so 1 in 10, go to charity. And I thought that was a good.
That's not a token amount. I mean, that's half your fees essentially. So if most hedge funds are going bankrupt and, or not going bankrupt, but just winding down in a couple of years, kind of like restaurants, you're really setting a higher bar for yourself to be successful, given the lower fee structure that you're netting, or that the fund is netting, right?
Absolutely. Yeah. So we have to perform, very exceptionally to succeed, more so than if we just kept the 2 and 20, kept the revenues for ourselves. But I just feel strongly, the hedge funds that are successful, they're kind of outwardly like super successful, make a lot of money. So if we're one of those successful funds, instead of having like so much money for ourselves, we could have a good amount of living, but then we can also give a lot of that to charity, so we don't have to have, be the type of fund where we're looking for the next house in the Hamptons. I mean, maybe we would, I don't know, but it's not like, we, at least we know we're giving half of it away, to charity, to a
And that's not the
foundation.
driver. I mean, for those who don't know, obviously, Emmett has done very well, as you said, but, I also left my job earlier this year, and money was not a prime motivator for me at that point either. So what I do find motivating, I think similar to you, is to, be able to be successful so that you can, have these outsized returns for investors, but then all outsized, giving for, charitable causes that we find can have an outsized impact on society as well.
Yeah.
So
Yeah, no, it's a good point. We'll get it. I think we should get into that a little bit. One thing I want to mention about the structure that's different is we wrote it into the prospectus of the fund that, half of the fees, half of the net fees we collect will go to charity, And so I haven't been aware. I think there's actually one other mutual fund company called Bridgeway, I want to say, that I was introduced to, when I was doing diligence, and I talked to them, and they're very good, and they have a similar mission. I don't know if I think they've been around for 10 or 20 years, and they're, I'm sure we'll partner or talk to them more as time goes on. But other than that, I haven't seen any investment managers, especially hedge funds, write into prospectuses like, hey, we're giving half of our revenue or half of our income to charity. What you see is these billion-dollar hedge funds, going to hedge fund cares or these events that are like set up to make hedge funds look,
right.
generous, right?
Yeah, so
But
if you're already at the level where you've got a successful hedge fund, and you can, throw off 1% of your, let's just say, net after
yeah,
after all your fees and everything, you give some token amount away. But this is not that.
yeah,
I mean, this
this
is
is not
legally
that.
biding,
Yeah,
significant portion of the
yeah,
fees.
half, yeah, yeah.
So
So it's different, yeah, it's because you might see a $1 billion hedge fund give, $100,000 away to some nice cause, and then get like and have their name shown on like the building or something, or maybe get a San Francisco 49ers parking space that from the use or whatever as a token. But you don't realize that $100,000 they gave away is probably 0.01% of the revenue that multi-billion-dollar hedge fund took in. So it's nothing. It's just a small token, like you said,
right,
right?
it's like
And
marketing expense, right? It's like it's
exactly,
very small.
exactly. Yeah.
Yeah.
So if we were able to get successful like that, we were becoming like if we ever became like a multi-billion-dollar hedge fund, knock on wood, I mean, could happen. You never know. But if we did, we'd be giving away hundreds of millions of dollars, every year. It'd be pretty impressive. And we were going on to the next topic with that, like how we want to give it and stuff. Yeah.
Yeah, so maybe, I know you started, your own family's charitable foundation. So can you maybe give an overview of that? And one of the things that I think is really interesting is, you talked about the parable of the sower, and these really outsized returns, which is, just obviously as an investor, and given your track record, that certainly applies. But I get the sense that you're really looking at this from three dimensions, at least as far as I can tell. Outsized returns for your investors, similar to what you've had personally. Um, Outsized good in society by kind of setting this example that capitalism can be for good. And then the third leg, which I think we're going to dig into now, is really using those charitable donations in a way that's incredibly impactful. So what are
Mm-hmm.
your thoughts on the foundation, and how to think about giving in a way that has that 50 to 100x return? Obviously it wouldn't be
Yeah.
financially, but really things
Yeah.
have a kind of punch above their weight class.
Yeah, exactly. So this is something I think I'm still working on. Like, but like you nailed it. The bird's eye view is I want to give. I want us to give from the foundation that I set up. And I donated a meaningful amount of stock personally in end of 2020 to it. So it's already got a couple, 2 to 3 million in there. I've started giving out slowly pieces here and there, but over time, as the fund grows and hopefully where it generates enough fees to pay for expenses and give half the revenue to the foundation, will become much more meaningful. The foundation asset level, and it has to give out 5% per year minimum, but I hope to give out much more than that in time. But things I've looked at is so far as early education, like charter schools in low income areas like New York City Success Academy, I've given a couple times to already, and so I feel like education at early ages has an outsized impact. If you can give a really good education to low income area communities, kids, that can change the lives of many of these kids forever from that point forward. Whereas if they were stuck in like the normal public schooling system that might not be so good in their particular area, in some areas maybe it's good, but in some areas it's clearly not. Then now you have a choice for some of these kids to potentially have a much better education system that has outsized returns as they grow up. Another thing I'm passionate about is diet and nutrition, and the diabetes terrible epidemic we have in our society. It's an obesity epidemic in our society, and it's hard for people to recognize and accept, but it's just getting worse. And so that's a passion of mine, to try to work on that. And I think nutrition reform is important. And so versus giving money to to pay for dialysis machines to hospitals to help people that already have diabetes, which is important. But I think a better, more outsized return is to try to help reform the nutrition guidelines to be more healthy for people, and penalize processed foods more and stuff like that, so that the diabetes type obesity doesn't develop as much, things like that.
Yeah, it's actually interesting. So when I was doing investment banking, one of the industry verticals that I worked on was in medical technology. And one of the industries I was working in was, cancers. So you had all these, super expensive high-end treatments, to try to treat, stage 3, stage 4 cancer, that would cost, Medicare and private insurers, tens of thousands of dollars per dose, just incredibly expensive, with frankly not great odds of patient success. Then on the other hand, one of the companies I was working for, I probably can't say who they were publicly, but they had an at-home test strip that you could use to detect cancer and stage 1 cancer, in a non-invasive way, at like a test rate of something. It was less than $100 per test. So you've got lower cost and better patient outcomes by catching it earlier. It's like multiples, hundreds of multiples, better outcome.
Dollar spent. Yeah.
The dollar spent. Yeah. So even if you spread, test more people than maybe you should, then the cost savings and the life savings will more than justify trying to be more proactive earlier on, rather than kind of reactive on the medicine with more invasive procedures and more expensive medications and worse patient outcomes. So I completely agree with you. I think especially kind of on the tail end of this coronavirus pandemic, it was certainly a terrible disease, but I think one of the things which maybe didn't get enough airtime was the prevalence of comorbidities, and obesity being probably number one among them. But even things like taking vitamins and getting outside and taking some supplements to really just improve your body's immune system would potentially go a lot further than just increasing the prevalence of or not dialysis machines, but the what were they called,
the oxygen machines,
ventilators.
Ventilators.
So I completely agree with you. That's you can, an ounce of prevention is worth a pound of
prevention.
Yeah, my mind is blanking.
No, I know what you're saying. I agree 100%. I think we're on the same line, and I think a lot of people watching will probably think the same thing. And it just makes more sense, common sense in every way, to instead of treating the symptoms, spending a lot to treat the symptoms, you try to prevent it from happening in the first place with more dollars spent up front and preventative care stuff. So I think, and another sort of pillar I'm thinking of with the foundation giving is also in keeping with the capitalism theme, is trying to give to small businesses. Like you see venture capital, you see the TV show Shark Tank, and
Hmm.
they're investing in small businesses, which I think is very good to do and important for our economy. But I would
Hmm.
like to have a different slant where we're kind of giving grants without getting, not so they're trying to sell us competitively to get an investment. Instead, we're just giving money to like a small business, whether it's like, a local ice cream shop or something that's employing people, or it could be some technology company that's employing people, but maybe they just need 50,000 or 100,000 extra capital up front to like give them a fighting chance to survive and become successful, where they can be employing many people and bettering the community around them or society in general or whatever. I
Yeah.
think that's sort of a little bit of a missing niche. I mean, the government gives grants, I think, to small businesses, but that's probably a much more complicated and messy process than I would imagine, given how bureaucratic our government is. But
Well, yeah, you
I
end
would
up
like
needing to
this to
hire
be
a grant
less.
writer in a lot of
Yeah,
cases, and it's like an
yeah,
expense. And if you don't get it, then you're actually, net worse off. And it's,
yeah, and it could take months or longer to. Yeah, so I
yeah,
want this to be a smoother, way to help businesses grow, and so that's another, I think, important way to seed for exponential returns on the money given.
yeah, yeah. So, that's really helpful. And I think you and I have both been vocal on Twitter lately, just saying, we really do believe in this project and in this firm that you founded. And these are, I think, the reasons that are really driving us to really do this, when, we could maybe sit back and do something that's a little bit less work, a little bit less risky.
Yeah.
But I want to turn maybe to the investment side. So what is
Yep.
the investment philosophy? I mean, are you going out and trying to, shoot for, another 13,000% return in 2021, like was achieved in 2020, or
Yeah.
what's the kind of the guiding philosophy?
Yeah, I mean, I think when just look for the opportunities. It's the fund. The name of the fund is called Accelerated Opportunities, and I think I thought of that name, or I use that name for a good reason. It's very opportunistic. And the market is sort of this enigma, and I view the market as always right. At least in this game of the market investing we're doing, by definition the market is always right. And if someone's complaining, hey, the market shouldn't be there, that person probably shouldn't be in the investing game or whatever, the investing world. So we have to adapt to the market and take advantage of the opportunities that we think are the best opportunities. And so last year there was some opportunities where the market was going to crash imminently with the COVID crash, I thought, and got ahead of that. And then I felt like at the bottom, time to buy back in with a bunch of long-term options, and it turned out to be correct. And the market went way up, and much faster than I thought too, but it benefited to that 13,000% return in 2021 or 2020. And I know that type of return, or those type of opportunities in the same year, especially, will probably never happen again. And it will regress to some mean, the performance of the fund. But I hope it doesn't mean that's negative. So I hope the fund will, over the long term, I really expect it to beat the market by a long shot. Any given year, I could severely underperform the market. And that's very possible, very likely certain years. But what we do is we kind of look for asymmetrical returns a lot of times. So we look for 10x or more return opportunities. And we often use call options or occasionally put options. And since you joined, Matt, you've been really helpful in helping to spot some of these, and we've kind of deployed some capital to certain opportunities. Some are still underway, and some seem promising. And you expect 4 out of 5 of them to go to zero, but if 1 out of 5 hits, then you have a 10x return on that or more. Then you
Mhm.
have a good overall return, right? So that's sort of the mindset I think we are kind of trained on looking for in some of the bigger opportunities. But we're also not just limiting ourselves to that, right? We've been thinking of other unique things, like we think the market's trading sideways for a while, so we've decided to be kind of a seller of options or insurance, to the market, when the options is expensive to buy right now, even though the market's trading sideways, or that's what we believe. We can generate, significant returns over time just by selling options on certain names that have high volatility. So we're doing the best we can to keep adjusting. I hate to corner myself. Most funds do kind of label themselves long, short, or special situations, or volatility funds, or whatever. And I think we're just kind of an enigma too, in that we just want to be adapting to the market always best way we see fit, and ways that we can understand. And that means our strategy is probably going to continue changing over time. But we're always going to be looking for kind of the outsized returns. That's for sure.
Yeah. So, I think given the fact that it has been, a bit sideways so far this year, I think a lot of people would have expected kind of coming into 2021 with, the huge, decrease in a lot of the growth stocks that we saw early in the year. There's been a bit of recovery lately, but the fund has performed, I would say, remarkably well. I mean, there wasn't any sort of huge kind of crash that you might expect, given a lot of the names that are in the fund. So I think that is kind of a testament to the adaptability that you're talking about. And I know on a lot of the Dave Lee interviews, you're talking about how much money you made selling buying calls, but to have the flexibility to say, I liked the pricing when I bought them, but now I don't like the pricing anymore. And in fact, I think it's so high that we're better off selling these now. And so I think that adaptability and that flexibility and I would say the lack of constraints that most typical hedge funds have, like you said, being long short, or I was actually talking to one hedge fund manager recently who was saying that they try to adapt the funds to the returns of the Sharpe ratio. They're trying to maximize for the Sharpe ratio, and so I think you get a lot of these really binding constraints that I think limit the creativity of the fund manager. And I mean, if you're paying somebody 2 and 20 to manage your fees, I think you kind of need to, or manage your funds, you kind of need to trust them to have the flexibility to do what they think is right in a dynamic market. So
yeah, it brings up a good point with the Sharpe ratio focus and such, because in my previous job, I saw a lot, and what drives capitalism is personal incentives in a large degree, especially in hedge fund managers, right?
mhm,
And so hedge fund managers, most of them just want to get rich and make as much money as they personally can. And how do they do that? The returns, yeah, of course, that seems obvious, but what really gets them rich is attracting a ton of capital into their fund. And
mhm,
so that becomes their focus more than the actual return of their fund. They want to kind of structure their fund in a way that the institutional investors are most likely to invest in them. So
right.
that means getting the Sharpe ratio to be perfect, for example. They're not, and so instead of like, they might, if they didn't have that constraint, they might be trying to maximize their fund in other ways, because the top priority is always to figure out, how do I get my fund perfect for the institutional investors to come in? Because if they get 100 million or 200 million dollars of institutional investors in their fund pretty quickly, then personally they're going to make a ton of money.
Yeah. So even if the fund loses 5% every year,
Yeah.
just the fact that they have such a large capital base, they're fine. They don't really care,
Yeah.
right?
Or if it only makes 5% instead of, it could have made 50%,
Yeah,
they
exactly.
still make more money than if it was just their own $3 million invested
Exactly.
in the fund or whatever. Yeah.
So let's take on that note, maybe let's talk about the investment criteria for the fund. They are strict, but I would also say it kind of goes to your view of kind of wanting to protect investors and not wanting to optimize for your own financial reward here. So what are the
Yeah.
investment criteria and why are they established the way that they are?
Yeah, so the minimum investment is 500,000 per investor. Um, One thing we've added is that we want that 500,000 or more, whatever they decide to invest, to be no more than 5 to 10% of the investor's liquid net worth, right? So we've had a number of people come and say, "Oh, I want to invest. I'm totally bought in, and their liquid net worth is 2 million or 3 million, and they want to invest 500,000 minimum," but we turn them down, because our fund is very volatile. Like there were some years between 2013 and 2019, when I was managing my own portfolio and kind of keeping a similar mindset for investing in this fund to try to do the most, what we think is the most risk reward opportunities out there. There's going to be some years where we're down 50% maybe, or more, who knows? But there's other years but it could go for a few years in a row where we're flat or down a little bit. And if someone's putting like a quarter of their net worth, into this, that's very stressful for me and for them, and I don't want
Hmm.
that to be the case. So that's why if someone has 5 or 10 million and they put 500,000 into the fund, then it's like, okay, if they lose a meaningful amount, that sucks, but it's not like their life is going to drastically change where they have to move out of their house or can't buy the house they wanted or things like that. So
Mhm.
that's sort of the thinking around that we've turned down a lot. And also people then say, oh, well, what about, can I just put in 250,000? And we haven't made any exceptions. That we've had a lot of people ask. And if you make one exception, you got to make them all, right? And so even friends and family, I turn them down for the same reasons. And if we made the exception, say, okay, we'll accept $250,000 or $100,000 investors, then all of a sudden we have like 10 times as many investors coming into the fund, and we just don't have the bandwidth to handle that ourselves right now. Like, we want to operate our fund as efficiently and as strongly as we can.
Mhm.
And if we're, spending all the time, vetting tons of new investors for smaller amounts, then we have less bandwidth to focus on our strategy and investing. And over time, we would love to get, and we've already researched it significantly, we'd love to get to a point to set up our own ETF. And anyone could invest in the ETF in that case, right? And that would be great. That would be the ultimate tool. But that's a little more an expensive undertaking and commitment. And so at some point, we might set up an ETF. We hope to, so a lot more people can get kind of skin in the strategy we run. But I always tell friends and family, ARK Invest has incredible ETFs, and I've been telling them for years and some have listened and done very well, and some choose not to. But there's some great ETFs out there. And our fund may not even outperform ARK Invest. That's an incredible company that does great research. We don't want to agree with everything they do or invest in, but I think they're pretty incredible what they do. So I hope that answers the question.
Yeah, no, absolutely. I mean, I think, ARK Invest is, we view internally as something of a benchmark against which we compare our own performance. But, and they've been incredibly volatile, and, what you'd say we're roughly twice as volatile as them. Is that a fair statement?
I would say, we're probably, our beta is like double to them, so yeah, it seems like it's not always the case. Sometimes they're up 2%, we're down 1%, or sometimes they're down 1%, we're up 2%.
Yeah,
But
we have a lot of
they're up
different
2%, we're up
names,
5%,
and
and
yeah,
vice versa. Yeah, we're more
yeah.
volatile. We use a lot of options, not only options, but we do use a lot of options. That plays into our volatility.
Right. And like you were saying, though, we're seeking, really these outsized returns. So rather than, optimizing to the Sharpe ratio and trying to get an institutional capital, like a lot of the hedge funds that you see out there, we really want to kind of swing for the fences but only with a very small group of names that we feel very, confident on. So what do you think about the concentration that we have in the portfolio, and kind of the amount of rigor and understanding we have around, a relatively small handful of names compared to someone like ARK or, a traditional long short fund, which may have, 2-3 dozen names in them?
Yeah, no, it's a good question. I think a lot of the potential investors who choose us, we want to be chosen because they want that asymmetrical risk reward profile in their net worth.
Mhm.
I don't want them to choose us to then have us diversify. Like they're
Because
already diversifying
otherwise,
by choosing us.
if we were
Yeah,
doing that, then we could take the full, $2.5 million of some accredited investor. Instead, we're turning them down, right? So,
yeah, exactly.
we're trying to not ramp up the risk, but to take calculated risks
That's
on names that we feel strongly about.
exactly. So we want to be that, instrument for their higher risk investment, so to speak. Like we don't want to be, diluting that choice by then over diversifying ourselves. Having said that, I think 60%, I did the math, 60% of the 13,000% returns was because of Tesla last year, or 65%. So, but even without Tesla, Tesla went to zero, still would have had a 5,000% return. So that's still pretty good, but we're trying to diversify a little bit. And
That may be an understatement. Yeah, that's
yeah,
5,000% still really good.
still really good. Yeah. So instead of having, 60% of our fund, return profile, but just on Tesla, we're trying to use some of the other ideas we have. So we might have, 4 or 5 main ideas we're focusing on at any given time, with a few kind of ancillary, shorter term speculative things that we think are good opportunities around it. but I think we're doing a good job with that because, you and I can focus on a lot of the fundamentals of these names. I know we've talked about Roblox, or we've talked about Lemonade or Tesla, obviously. So, those are three of our core positions right now, for example, and we spend a lot of time researching them and trying to make sure we're convicted in the medium term, the long term reward. And then we have shorter term things we do. We haven't really disclosed them, but some of them have really good returns and some of them kind of go to zero. But as long as you get a few of the ones that have really good returns, then overall it's a pretty good return on that capital used for those. So we're doing a mix of things, but at the same time, we're not diversifying to like 20 names or 10 names even, so we're really trying to stay true to, I think, what the intention of people investing in us is to have a high risk investment in their portfolio.
Right. Yeah. So one of the other things, I think maybe a common theme on this whole conversation has been that, good soil is different in almost every regard from other hedge funds out there. But maybe one of the other ways that it's different is just in the ability to talk this openly about, the historical returns and, some of the things that we're doing. You go to most hedge funds page and there's just like, whatever capital log, like investor login, and that's like the whole page. So how are you structured differently in terms of being able to market a little bit more openly and kind of talk about our returns a little bit more openly?
Yeah, so I'm very good friends with our general counsel that was listed on our fund, Simon Rivelis. I've known him for about 10 years from my previous job, and he's set up hundreds of hedge funds and very confident in his ability to structure and do all that stuff. And so we used his services to set up this fund, and I talked to him about it, and we decided that, there's this designation in the last few years that's been allowed called the 506C regulatory filing of a fund, I think is what you call it. And that means we can, only about maybe he said maybe like 5% or less of hedge funds form with this designation. But what it does is it allows us to market the performance openly to the public. This is very unusual for hedge funds, right? So because the performance was so strong in 2020, and that we want to market it going forward and show how different we are, I thought that was appropriate. There's some limitations. I think the way we set it up, we can have a maximum of 99 or 100 investors. But if we get close to that point, there's workarounds where we can set up, other entities to be the investor, and lots of people can go to those entities. So, but that's later. We've had, I think we're getting close to like a dozen investors or something in the fund, maybe overall, maybe more soon. So I don't know when we'll reach that limit, but we've only been taking investors since February, or since middle of the first quarter, and there's a lot of interest. We've had to turn down a lot of people. There's a lot of people watching, a lot of people kind of starting the paperwork now. But as our return hopefully improves over the rest of the year, we think we'll attract. There's a number of like institutional investors already looking at us that we're on their radar, and it's promising. So I think, keeping with our theme of disrupting the hedge fund industry in many ways, this is another way we've done it, is being able to market our returns openly on our website and to the public.
And so if there are folks out there, who kind of meet those investor criteria, how can they find more information or reach out in the best way?
Yeah, I mean, if they go to the website, and enter their information, goodsoilinvestment.com, then they can type in their email and contact information, and we'll respond. We have a whole process to respond quickly to them, and they're in our database forever. And when we have a quarterly investor presentation, we'll update everyone when that is with information. And if they meet our criteria to invest in the fund, we'll obviously begin discussions and with them as soon as they're ready to talk about, what other questions they have before they're comfortable with investing in the fund or not.
Well, thank you, Emmett, so much for your time. I haven't been able to post a video on the Spark Spread channel for some time. Obviously, that's because I've joined the Good Soil team. So Spark Spread, for those of you who maybe are fans of that but aren't familiar with Good Soil, hoping this can be some sort of transition video. Good Soil does have its own YouTube channel, so going forward, I think we'll probably post this video on there as well. We'll probably have some future conversations as well, maybe a little bit more regularly, which we'll post on there. So I'd encourage anyone, if you're interested in learning a little bit more about this, or even just kind of hearing Emmett's perspectives, go and subscribe to that Good Soil YouTube channel. We'll start putting some more content out there. I'll put the link in the show notes here as well. But maybe we can just end it, Emmett, with, I think we've touched on this already, but, in terms of the longer term goals of the fund, but, where do you see, if Good Soil's, successful in the next, 5-10 years longer term, obviously it's not, you having, X amount more money, but what would be truly impactful for you? What would be a legacy that you'd be really proud of?
Yes, I mean, I think if we could see a trend growing, and like I said, there's another firm, Bridgeway, I think that's been doing this much longer than we have, and there's probably some other funds or investment companies out there too. But if we could see a trend growing, if we could participate in growing a trend of giving back by the most successful investment managers, I think that would be incredible. Like, putting into prospectus, like, hey, we're giving X% of our fees to charity, and put that in the prospectus as a rule, as a legally binding rule for the fund management company or the fund manager to follow. If that could be a trend, similar to how ESG has become a trend, then that would make me really happy. Even if our fund fails in the end, if that trend catches on and picks up, I think that could really do a lot over the next 5 to 10 years to kind of keeping socialism at bay. I think there is a transition to like a universal basic income. I think there is a transition to that, a smooth transition that could be done. I'm just worried in like the next election cycle or the one after, there was going to be kind of a rash transition, and it flips too quickly, and it damages our economy and the underworkings of it too much to ever kind of return to a prosperous one again. And I'm just worried. I'm hoping to divert that and avoid that. So, that's what I hope this helps change that perception of younger people, especially if they see a lot of donations to schools and it's coming from like hedge fund managers or investment managers. I think that would be good for, for the perception of capitalism.
Yeah, I'd love to see Bernie Sanders try to, critique Good Soil at some point. Like if we ever get so successful that, like the fund is making, a lot of money and giving it all away.
Yeah.
It's almost like an iron shield where you can't, even if you're, the hardest socialist out there, it's hard to criticize someone who's generating so much, good for the world and just donating it directly. So
yeah, absolutely.
I'm completely on board with that, and it's a mission I can get behind. Outstanding returns for the investors, doing good for the community, and being an example for the next generation out there, and for the next generation of fund managers to really, I think, take some of the worst reputation out there, the Wall Street hedge funds, and kind of turn it on its head and have that be a source for good for society. Something I can really feel good about.
Yeah, it's evolving capitalism, and if it doesn't evolve, it's going to die out from some other, other type of thing like socialism, I think. So it's got to evolve, and this is a good way to do it, I think. So, wealthy people can stay wealthy and make a good amount of money, but know that their wealthy returns are also contributing to charitable giving in a significant way.
Yeah, absolutely. Well, hey, thank you so much for, not only your time here today, but, especially for bringing me onto the Good Soil team. It's been a privilege, and love the work that we're doing. And thanks so much for your time, Emmett.
Yeah, it's a pleasure having you on board, and it's incredible. We'll have to do a story about your backstory one of these days too. Next time.
Maybe it's a little bit less exciting, but maybe
I don't know. It's pretty exciting to me. All right.
You talk about climbing wind towers and wind turbine towers, and I've got a weird background. It's like a lot of heavy finance, but then also like, working in combined cycle gas plants and climbing wind towers. So I don't know. It's a weird one.
Yeah. No, it's good though. All right, man.
That's it for this week. And again, make sure everyone subscribes to the Good Soil channel. We probably will have a couple other follow-up videos like this. So thanks a lot, everyone.
Thanks.